Imagine this. You've been working for years, skipping dinners out, driving the same old car, saying no to vacations, and quietly watching a number in your bank account slowly climb. And then one day you log in, and the balance reads 20,000, maybe more. And for a moment, just a moment, you feel like you finally made it. That feeling is real. You earned it. But here's what nobody tells you. That exact moment, the moment right after reaching a meaningful savings milestone, is one of the most financially dangerous moments of your life. Not because the money is at risk from the outside, but because of what happens inside your head and how you handle the next few weeks and months. After that milestone will largely determine whether that $20,000 becomes the foundation of long-term financial security or quietly disappears and leaves you starting over again. There's a common belief that wealth is built through dramatic moments. A big raise, a stock that explodes, an inheritance, a lucky break. We've been conditioned to think that financial freedom is reserved for people making enormous incomes or making bold, brilliant investment moves. But that's not how it actually works for most people. The truth is, financial turning points don't happen at the $1 million mark. They happen at the small ones. At $5,000, at $20,000, at $50,000. These early milestones are where habits form, where identities shift, and where the patterns that lead to either wealth or stagnation get locked in. The big numbers are just the result of what you decided to do at the small ones. So why does $20,000 matter so much? Not because of the number itself, but because of what it represents behaviorally. For most people, this is the first time they've ever held a meaningful amount of savings in their hands. It's real money. It feels like a cushion. It feels like proof that discipline works. And that's exactly where the danger begins. Because that cushion creates psychological permission to relax, permission to reward yourself, permission to finally stop being so careful. This is the behavioral threshold. It's the moment where money stops feeling scarce and starts feeling available. And once money feels available, the brain starts looking for ways to use it. Here's what happens neurologically. For months or years, your brain has been operating in a kind of financial survival mode. Every purchase gets evaluated. Every dollar feels significant. You've been running on discipline and delayed gratification for a long time. But when you hit that milestone, the brain shifts. It moves from survival mode into reward mode. And reward mode is loud. It says things like, "You've been so responsible, you deserve something. You've been driving that old car for 3 years. It's time for an upgrade. You've been working so hard, a vacation won't hurt. You've earned this. And maybe you have earned it." That's not the argument. The argument is timing and cost. Because what feels like a reasonable reward at the surface level often carries a much larger price beneath it. Let me give you some numbers because the math here is uncomfortable in the best possible way. Say you have $20,000 and you're also carrying $8,000 in credit card debt at 22% interest. Paying that debt off first isn't just the responsible choice. It's the highest guaranteed return you can get. Because eliminating a 22% interest obligation is mathematically equivalent to earning 22% on your money. No investment can consistently promise that. Now let's say the debt is gone and you have $12,000 left. If you invest that in a diversified index fund and leave it alone for 30 years, assuming a conservative average annual return of around 8%, that $12,000 grows to roughly $20,000 without adding another dollar. But if instead you use that money for a car upgrade, a newer model with a monthly payment, you don't just lose the $12,000. You lose every dollar that $12,000 would have compounded into. Plus you add a monthly obligation that drains future contributions. The true cost of that car isn't the sticker price. It's the financial future you quietly traded it for. That's opportunity cost. And most people never see it because it never shows up as a line item on a bill. This is also where identity becomes the most important variable in your financial life. Wealth is not built by people who are the smartest in the room. It's built by people who consistently behave like investors rather than spenders. That shift from thinking of yourself as someone who is trying to save money to someone who is systematically building wealth changes every decision. When you're a spender, milestones feel like permission to spend. When you're an investor, milestones feel like momentum to protect and grow. It's not about being restrictive or joyless. It's about having a clear sense of what your money is for and making sure your daily decisions line up with that vision. That shift is less about intelligence and more about systems. Because when emotions are high, and they're always high right after a milestone, systems make the decisions so you don't have to. Which brings us to the correct financial order. Not the most exciting order, not the order that makes for good conversation, the one that actually works. First, eliminate high-interest debt. Anything above 7 or 8% is costing you more than you're likely to earn investing. Clear that first. Second, build a real emergency fund. 3 to 6 months of expenses sitting in a separate, boring savings account, not invested, not accessible through a credit card. Just there, as a buffer between you and financial disaster. Third, maximize tax-advantaged accounts. accounts and a 401k, a Roth IRA, whatever your country's equivalent may be. These are not glamorous, but the tax benefits are real and they compound quietly for decades. Fourth, automate your contributions. Set the amount, set the date, and let the system run. Remove as many emotional decision points as possible. Structure protects you from yourself, and that's not an insult. That's just an honest understanding of how human psychology works. One more misconception worth addressing. You've probably heard the argument that small daily expenses, the coffee, the lunch, the subscriptions, are the real enemy of wealth. And while small expenses do matter at the margin, they are rarely the main event. The decisions that truly destroy long-term wealth are the large recurring ones. The car you buy that's $300 a month beyond what you need. The apartment you rent that's $500 above your actual budget because you finally feel like you can afford it. The lifestyle that quietly inflates every time your income or savings take a step up. These aren't small leaks. They're structural ones. And once they're locked in as monthly obligations, they don't just cost you money, they cost you the compounding that money would have done for decades. There's also the question of income, because saving and investing more becomes dramatically easier when you earn more. And one of the highest return investments you can make at this stage in your life is in your own earning potential. A certification, a skill, a course, a strategic career move. These are financial decisions too, even if they don't feel like it. If investing $2,000 in developing a skill leads to a $10,000 salary increase, the return on that investment dwarfs almost anything the stock market can offer. Career leverage is one of the most underused tools in personal finance, especially for people in their 20s and 30s. And now the warnings, because right after a savings milestone is also exactly when the most common financial mistakes tend to happen. Trying to time the market, jumping into day trading because the account balance makes you feel like a real investor now, buying individual stocks based on tips and trends, moving in and out of positions based on news cycles and emotions. These behaviors tend to show up right after progress, and they almost always give that progress back. The market rewards patience far more reliably than it rewards cleverness. Index funds, low costs, long-time horizons, boredom as a strategy. These aren't exciting ideas, but they're honest ones. Let's close with something that might seem simple, but is easy to lose sight of. Every dollar you spend today is not just $1. It's every dollar that dollar would have become over time. When you spend $500 on something unnecessary at 30 years old, you're not spending $500. Depending on your investment horizon, you might be spending $5,000 or more in future value. That's not a reason to be paralyzed. It's a reason to be intentional. Time is the most powerful variable in wealth building, and it's also the one you can never get back. Starting later doesn't just mean saving more, it means working longer. Every year of delay costs you not just money, but time. Working years that could have been optional. So here's where we end up. The difference between the people who build lasting financial security and the people who stay stuck is rarely income. It's rarely luck. It's rarely one big brilliant decision. It's the quiet accumulation of disciplined, consistent, emotionally controlled choices made over a very long time. Saving $20,000 is not the finish line. It's not even the starting pistol. It's the first real test. It's the moment where the habits and identity you build either set the foundation for everything that follows or don't. The boring path is the right one. Automate. Be patient. Protect your compounding. Grow your income. Avoid lifestyle inflation. And understand that the goal is not to feel rich today. The goal is to actually be free, eventually permanently, and on your own terms. That's worth more than any reward you could buy right now.